Chip stocks surged last week, and the market rallied to new highs after Fed Chair Jerome Powell, in his speech at Jackson Hole, signaled the central bank may cut interest rates in September. Powell's dovish tone pushed odds of a September rate cut from 70% to more than 93%. Chip makers saw outsized gains because lower rates heavily impact growth prospects and the significant capex investments required to achieve them. The probability of a cut now sits around 88.2%, according to futures contracts tracked by the CME FedWatch tool. Last Wednesday, President Donald Trump demanded Fed Reserve Governor Lisa Cook resign amid allegations of mortgage fraud, which could have far-reaching implications for sectors and industries. This week, all eyes shifted to Nvidia Corporation earnings, which reported Q 2025 post-market yesterday. Long a tech sector and chip industry bellwether, investors will be watching closely to see how the market reacts in the coming days. A rippling effect could impact the broader market and semiconductor industry. Nvidia is among the industry leaders in performance in the past year, 40% plus. Bullish sentiment on Wall Street has been especially high with respect to demand in Asia. Wedbush analysts, citing Asia Field checks, estimate that demand to supply is 10-1 for Nvidia's golden chips. But as Nvidia's stock continues to rise, its valuation stretches. And even considering the massive growth prospects, our quant ratings indicate there are more attractive options in the semiconductor industry. Nvidia reported stronger than expected quarterly earnings, with revenue reaching 46.74 cents a billion dollars and earnings per share at 1.5 cents, both slightly above analyst estimates. The company forecasted around $54 billion in revenue for the current quarter, signaling continued growth of more than 50% and underscoring strong global demand for AI infrastructure. Despite the solid results, Nvidia's stock slipped in extended trading as data center revenue of $41.1 billion fell just short of expectations for the second consecutive quarter. Overall revenue rose 56% year over year, marking the ninth straight quarter of growth above 50%, though it was the slowest pace since mid-2023. Net income increased 59% to 26.42 cents billion. Tab CNBC2 Nvidia's growth remains driven by its data center business, with $33.8 billion in GPU sales slightly down due to delays in shipping its H20 chip to China, while networking product revenue nearly doubled to $7.3 billion. The company said it could generate $2 to $5 billion in H20 sales next quarter if U.S. licenses allow shipments to China. Executives expect AI infrastructure spending to reach $3 to $4 trillion by the end of the decade, highlighting the scale of the ongoing AI boom. It's a remarkable run for Nvidia, which continues to set the pace in the AI era. Even with some short-term bumps in data center revenue and challenges in China, the company is still delivering record growth and maintaining its leadership position in one of the fastest-growing markets in tech. The momentum suggests that Nvidia's story is far from over. But is Nvidia a buy? Putting the hype aside, one question looms for many investors. Is Nvidia the best chip stock to buy? According to SA Quant Ratings, the answer is no. Dragged down by weak valuation metrics, Nvidia's quant rating is a hold. Noah's Ark Capital Management goes as far as rating it a strong sell, given its valuation is unsustainably high with slowing growth momentum and increased geopolitical risks, especially from China's competition and export restrictions. As alternatives, SA Quant identified two strong buys that benefit directly from Nvidia's success: Taiwan Semiconductor Company Limited and Micron Technology. Both sit at the heart of Nvidia's ecosystem and are riding the same powerful AI trends. In fact, TSMC and Micron are the two highest quant-rated semiconductor stocks. TSMC and Micron have much better relative valuation and EPS revision grades and match Nvidia in profitability. All three showcase A-plus profitability grades. NVDA has seen 23 downward earnings revisions in the last 3 months versus 23 up revisions. NVIDIA is trading at a significant premium to TSMC and Micron based on every key valuation multiple, including price to sales, EPS, operating profit, and price cash flow. NVDA has a forward non-GAAP PE of 42x versus 24x for TSMC and 14x for Micron. And even if you factor in growth projections, NVIDIA's PEG FWD is substantially higher than TSMC's and Micron's. Another key metric that illustrates TSMC and Micron have a more attractive valuation framework is EV/EBITDA, a metric that provides a clearer view of earnings by stripping out accounting conventions relative to enterprise value. This begs another question. Why are TSMC and Micron trading at such a significant discount to Nvidia? The market appears to be putting a huge premium on Nvidia's growth potential and projections, which are astounding. Nvidia's forward growth metrics are hard to top. However, they come at a steep price according to SA Quant Ratings, and to such an extent that Nvidia is a hold. While the stock may have been great to keep in your portfolio, its F valuation grade is weighing down its overall quant rating, so I've highlighted why TSM and MU are rated strong buy. Nvidia gets all the media attention and grabs headlines, but two downstream players in the semiconductor supply chain are showcasing better collective investment fundamentals. Both have dominant market positions, one in the global chip foundry industry and the other that has a key source position in the LPDDR data center market. Number one among quant-rated semiconductor stocks, Micron is showcasing A's in growth, profitability, and EPS revisions, along with B's in valuation and momentum. Micron revisions, momentum, and revisions factor grades have risen steadily over the past 3 to 6 months. Micron specializes in memory and storage solutions, focusing on system memory, flash storage, and high-bandwidth graphics memory, serving industries ranging from PCs to data centers. Micron's largest customers include tech titans Nvidia, Apple, Dell, Lenovo, Intel, AMD, Qualcomm, Microsoft, IBM, and Cisco. A key competitive differentiator is Micron's sole source position in low-power DRAM for data centers, a technology the company expects will see broader adoption. LPDDR, or low-power double data rate memory, is designed for devices that need to save power, such as smartphones and laptops. Micron began adapting LPDDR for data centers in 2023 and became the first to commercialize it through a solution developed with Nvidia and launched in March 2025. While Samsung and SK Hynix have the technology to compete, neither has yet targeted this niche. Micron shares jumped 5.6% after raising Q4 guidance earlier this month, citing improved DRAM pricing and strong execution. Micron momentum has continually increased, up almost 25% in the last 3 months and nearly 40% year to date. Strong results in Q2 were driven by surging demand in the AI business and data center markets. Data center revenue tripled and demand rebounded across industrial, automotive, and distribution markets after a period of softness. Analyst expectations are high, with EPS long-term growth forward at a staggering plus 63% for an A-plus growth grade. Micron EPS is projected to grow by 524% in fiscal year 2025 to $8.11, according to consensus estimates, and another 56% in fiscal year 2026. Micron has an A-plus revisions grade, driven by 20 upward earnings revisions to 0 downward revisions. Micron's huge fiscal year 2025 growth estimate is partly the result of a low baseline set amid the memory market downturn. Micron's market position has helped support strong profitability with an EBITDA margin at 46% and net income margin of 18%. Micron continues to invest in growth with CapEx sales at almost 40%. Micron has the best valuation grade among the 3 stocks in this analysis, trading at a PE that's at a 38% discount to the sector and forward price representing an 87% discount. Micron is trading at a deep discount in light of its position in a fast-growing AI chip market. Micron's potential mispricing could be around concerns that it is another cyclical chip stock. However, according to SA analyst Julia Ostian, the company's vertical integration and operating leverage amplify profits during upcycles, and AI demand is still in its early stages, making Micron a long-term compelling investment. Taiwan Semiconductor Manufacturing Company recently hit a record high after Taiwan announced the chip manufacturer would not have to pay a 100% tariff on imports to the United States. This provides a significant competitive advantage as TSMC continues to expand its global manufacturing footprint. The company has received a notable endorsement from Nvidia CEO Jensen Huang, who praised TSMC during a visit to Taipei, stating that buying a stake in the company would be very smart. TSMC remains a leading contender in the AI semiconductor space. TSMC has a 35% share of the $72.29 global semiconductor foundry market and a 67% share of the pure-play foundry space, producing chips for some of the world's largest tech companies, including Nvidia, Apple, and AMD. TSMC's dominant market position has consistently supported strong profit margins and cash flow. With demand running high and capacity tight, TSMC has been able to maintain strong pricing levels, while cost improvement efforts have offset unfavorable foreign exchange rates and higher costs of new factories overseas. TSMC's historical growth across the board has been staggering, and the forecast shows there is no slowing down, with earnings projected to grow 38% in fiscal year 2025 and 14% in fiscal year 26. Net sales in Q2 rose 38%, and net income and EPS grew 60%, driven by continued robust demand from AI and high-performance computing markets. In the company's Q2 earnings call, TSMC CEO Wei highlighted the explosive growth in token volume from AI models, noting that this surge in computation directly translates into stronger demand for the company's most advanced chips. TSMC has an EBITDA margin of nearly 70%, and net income and levered free cash flow margins that crush the sector for an A-plus profitability grade. TSMC has 10 upward earnings revisions in the last 3 months to 0 down revisions, and has beaten earnings in 16 straight quarters. TSMC offers a 1.23% dividend yield with an 11% 5-year growth rate. Although the payout ratio is high compared to the sector, the company has delivered a dividend payment for 20 consecutive years. TSMC is a high-growth, high-margin chipmaker with a dominating global share of the market and is well-positioned to ride Nvidia's coattails. Micro and TSMC share many strengths with Nvidia, but come at a much more attractive valuation. Both stocks have key strategic footholds in different portions of the semiconductor industry, high earnings expectations, and are trading at substantial discounts to Nvidia. Moreover, both stocks are well-positioned to benefit from the AI and data center megatrends that Nvidia is riding. Thanks for watching. See you in the next one.